In this video, I'm going to be breaking down the various uses of the medical savings accounts like the HSA and the FSA so that you can maximize and get the biggest bang for your buck. Get the pen and paper out. Hey everybody, this is Dominique Henderson with djh-capital Management coming to you on YouTube today with more for your life and money, helping you to make the better, bigger decision. And today, we're going to be covering a topic that we've covered before a little bit with the medical savings account, helping you to figure out how exactly to use it, what to use it for, and a couple planning points to consider when you open these up. Let's get started. All right, now the medical savings account, specifically the flexible spending account, called the FSA, and the health savings account, the HSA. We have covered what the differences are between those two accounts in a different video. And all you need to do is just click the link up in the cards and you can look at that. Today, what we're going to really focus on is how to use those particular accounts. In general, these are accounts that are used to pay for medical expenses on a pre-tax basis. And you have to have obviously that type of account with your employer. Now, each of these accounts have their pros and cons. So the natural question is, why would I use either one of these accounts versus just paying the money out of pocket, right? And so the first planning point that I want to give you is your effective tax rate, not your marginal tax rate. You know, they change the brackets all the time, and each dollar that you earn after it goes past a specific bracket earns a different tax rate. Really what you want is your blended tax rate, right? That's your effective tax rate, meaning that for every dollar of income you earn, what goes out to the government? So let's just say, for instance, your effective tax rate was 20%, meaning that every dollar you earn, 20 cents goes out to the government. Now, with a medical savings account or a FSA or a HSA like that, these will be above the line deductions. Above the line deductions reduce your taxable income dollar for dollar. And these are the best type of tax deductions to have. So what happens when you contribute the max or any amount for that matter to either the FSA or the MSA or the HSA in a given tax year, what you're doing is effectively reducing your effective tax rate that we just talked about. So they're going to always be beneficial in that regard. Now, if you need some specifics or some more precise tax calculations, feel free to email me at feedback@djhendersonsr.com, and I'll put that email address below so that you can, or so that I can maybe be able to help you a little bit further. All right, let's get a little bit more into the how. Now, first of all, these accounts have specific limits. For the HSA, you're not going to be able to contribute any more than $6,900 for a family in the year of 2018. And these are going to change every year by the IRS depending on a couple of things, inflation, and really what the average deductible, annual deductible is going to be on any type of high deductible health plan. So for families, it's $6,900. For for singles or individuals, it's $3,450. Now, everything that you contribute into your HSA or FSA will be, or is, let's say, useful for or can be used for medical expenses. And so the use of the account is really up to you. What I would say as a planning point and as a certified financial planner is just keep receipts of those medical expenses, whether that be things that you buy at the pharmacy or eye care or prescriptions for eyeglasses or contacts, things of that nature, whether you're doing co-pays at the doctor. All these different things are usually, if you look through your employee benefits, are going to be listed, the different uses you can have for that account. So it's basically everything medical in nature. So the tax law is that if you're using the proceeds in this account, your contributions plus the earnings, if you have something like an HSA that allows you to invest and grow that money on a tax-free basis, then anything that comes out of that account must be used for medical expenses, right? So there's even some instances in which you can use those those monies for long-term care premiums if you are eligible. So it's pretty verbose and all-encompassing when it comes to using it for medical expenses, and that's the key. Use it for medical expenses, keep track and records of your purchases out of that account, and you should pretty much be good to go. Now, one thing I would say as a bonus, just to kind of be aware of, is these are very, very tax beneficial accounts for the consumer and also for the employer. So what you might also see in some benefit plans and medical plans is that the employer will waive premiums to sign up for the high deductible health plan versus the PPO or the HMO that they offer. And you want to be aware of that because you can really do a quick break-even analysis to see whether or not it just makes sense to participate in the high deductible health plan versus your PPO. Now, you're going to have lower deductibles in your PPO versus the high deductible health plan, but at the same time, if your employer is paying the premium every month or even contributing with a match towards your HSA, you need to consider all of that before you make a decision on the PPO or the HMO or the high deductible health plan. That's all for now. Hopefully this has been helpful. Hey, leave me a note down in the comments to let me know if this has been beneficial for you, and we'll talk to you later. Bye-bye. And I do realize that at the time that this video is going to be released, we are entering that phase of employee benefit, the calendar year of the employee benefit election period. So if you want any extra help, make sure you hit me on that email, feedback@djhendersonsr.com, so that I can probably help you or guide you in the proper way to choose those benefits.